What is going on, everybody? This is S Trades, and this is day 10 of the bootcamp. And in this video, we're going to be going over liquidity part 2, which is, in my opinion, one of the most important videos that you guys have to understand like fully, because a lot of the times, most of the strategies and everything revolved around not only just ICT, but a lot of other strategies revolve around liquidity. Like that is kind of where every strategy starts from. This is like the building blocks for every single strategy, right? So without further ado, let's get straight into the video. So as we talked about in the previous liquidity video, it was just kind of the basics. I just showed you what liquidity is and things like that. Why is it significant? So that was just kind of the basics. And for this part 2, we're going to be going over the specific liquidities, like what are the most important liquidity zones, how to see them, how to target them, why they're important, and things like that. So we have a few in this video. So starting off, we have a session liquidity, right? We also have previous day highs, previous day low liquidity. We have low resistance liquidity, right? As you guys see on both of these ends. We have equal highs and equal lows. And finally, we have data highs and data lows, right? So all of these liquidity zones are very, very extremely important for you guys to understand, because they all act as legit like magnets, right? Like that's where price wants to go, and it will be a lot easier for you guys to identify drawn liquidity where, you know, certain direction of the market could be going at a certain time. So this is perfect kind of to start off talking about them, because we talked about time in previous video, we talked about fair value gaps, we talked about all the basic things that you would need up until this video. So let me just stop yapping. Let's get straight into the first liquidity. Okay, so the first liquidity zones are session highs and session lows, right? So as talked about in previous video, what were the important times to trade in? We talked about previous sessions, right? The sessions being Asia and London, right? So the Asia lows and Asia highs and London lows are very, very important. They act legit as magnetic like fields of price to go and retrace to take those levels out, do liquidity sweeps and things like that. So it is very, very important to understand this. So as you talked about the previous video, right, Asia starts from 6 to 12 a.m. and then London goes from 12 to 6, and then New York ends up starting from 8 to all the way up until 4, right? So the importance is you always have to pay attention to these session highs and lows, because that's where a lot of liquidity is resting at. That's where price usually accumulates these important liquidity levels, where a lot of stop losses are going to be resting at. If some people are trading during those sessions, a lot of the times one of those highs or one of those lows will get taken out, and that'll go into the opposite direction of the previous either high or low, whatever direction that we're going into. And then usually when the New York opens, right, a lot of the times what New York traders will be doing, they'll be targeting those, for example, London high, London low, Asia high, and Asia low, because they are really act as magnetic fields of where a lot of liquidity are resting at, right? So in this demonstration, right, we have Asia high and Asia low. A lot of the times, right, Asia won't do really much in terms of like moving, right? So kind of just accumulate. We'll get our extreme high and extreme low. It'll usually stay there, and then once London session opens up, then London will either take out one of these levels, right? London, for example, in this case, we take out the Asia low, right, and then we kind of wick out, make a liquidity sweep, and then we kind of start to come back up, then to take out Asia high, and then we form a London high, and then we form a London low. And as time approaches New York Stock Exchange, right, a lot of times we're going to be doing a manipulation, right? And a lot of other strategies, for example, AMD, right? Accumulation, manipulation, distribution, and power of 3, and all these things. There's lots of strategies that revolve around liquidity, like I mentioned. So, for example, Asia will accumulate, and then London will manipulate into New York, and then New York will end up distributing, right? So in this case, right, Asia accumulated, made the Asia high and Asia low. London then took out those levels. London then took out London low, going into New York open, making that manipulation. And then once we took out the very important low, which was the London low and the Asia low, right, then New York will end up expanding back up to London high and continue up. And in these scenarios, you also have to pay attention to the displacement, right? And how much displacement do you see throughout these session highs and lows, right? So if you see if you see an Asia high and Asia low get wicked out and then go into the opposite direction, then you could see that these sessions are getting respected, right? So let's say in this case, London low, right? New York sessions are coming lower, taking out that London low, but you don't really see much follow through or a lot of displacement, right? You just kind of see wicks below it, and then you start to see price build back up higher. Then you could have this London high as drawn liquidity, because now you see that a very significant low got swept, and now price is most likely to run up and take that London high, right? Now this isn't 100% guaranteed again, right? These concepts aren't meant to be like, all right, you see Asia low and London low gets so that's just long that and then target London high. Like, no, that is not how it works, right? These are all the tools that could be very helpful in your arsenal in order to like form a strategy, right? So if you see, let's say, London low and Asia low get taken out into New York open, and then you start to see a lot of displacement back up, right? Then you can start to see some sort of like an inverse fair value gap right here, or some higher time fair value gap getting respected, or something like that, right? So we'll get into the more of the strategies later, but this is essentially why session liquidities are very important. This is where lots of liquidity are getting built up for the New York session, because New York session is usually where lots and lots of volume and volatility is getting kicked in the market. So like I mentioned in the previous video, this brownie line kind of looking like, or whatever, is Asia session, and then this blue session is London session, and then these two lines are just pre-market, right? So as you guys could see, right, we form a high, we form a low for our Asia, right? What happens then? London ends up coming up, taking out the high, right? Boom, the high got taken. What happens then? Price ends up coming all the way lower, right? Almost wicking out this Asia low, right? And then, as you guys could see, as the New York starts to approach, right, where here's 9 o'clock and the 9:30 is in between. As the market opens, right, we end up coming all the way lower, right, taking out the Asia low because it's a very significant liquidity pool, right? So then once you see that, look at this majority, like crazy wick end up getting left behind, then what can you do? Then you could start targeting the London high, right? And as you guys could see, we have lots of displacement and follow through throughout that candle, right? Because again, we swept the Asia high, right, came down lower, took out Asia low. As the New York, see how London didn't really take out Asia low. So this is also very important because the liquidity pool wasn't taken out yet. So this could be a very important area for price to manipulate into and then go up or whatever direction that we're looking for, right? So another example right here, right? What do we have? We have Asia low get created and Asia high get created, right? So then what happens in London? London comes up lower, taking out the Asia high, come up all the way high, right? We still don't take out the Asia high, right? Meaning that this is still a very important, significant liquidity pool, right? Then price ends up retracing back into a certain PA right here. Was probably like a 30-minute fair value gap over here that got respected, and then we see a very big wick that was a manipulation move, right? And then we end up trading up higher again with lots and lots of displacement. What do we have here? We have Asia high get put in, right? And I have Asia low get put in, right? So this is what I'm talking about when I talk about displacement. So as you guys can see, as Asia high gets put in, we have London pretty much taking out this level and leaving a wicks on at the top, right? Not really any follow through. So then as it approaches pre-market New York open, right, we just kind of dump through this Asia low, right, confirming the bias. But then heading into the next day, right, we also leave off of this London high, which is again a very significant liquidity pool, right, into 2 p.m. So boom, once we take out this London high, right, going again into the next session, right, we have another very important pool again forming, right? This is Asia high got put in right here, right, and Asia lows over here, right, which is not really significant. And then as you guys could see, as the highs got taken, and then London ended up following through all the way down, and she has a lot of displacement following through. That means price wants lower price, so we could potentially target the next targets, which is this low, right? So these important session tools are very important. They literally act as magnets. And last example, right, what do we have here, right? Price ends up accumulating an Asia session, creating Asia high and Asia low over here, right? Then London opens up, we create a London high and a London low. And as the market starts to open up, we start to see this big manipulation into these zones, right? Market manipulates higher, taking out the Asia high and the London high, right? And as the market manipulates, then the next target, as we could see, would be London low and the Asia low. And as you guys could see, price ends up absolutely smashing those profits, right? Smashing those liquidity zones. You guys can see there's a lot of displacement, there's a lot of follow through, right? You see how this first wick candle wasn't really a confirmation. This could have been a potential liquidity sweep, right? Could have swept Asia low, right, and then seen price come up all the way high back up to take out the pre-market highs, right, and then the 9 a.m. high. But instead we ended up seeing a lot of displacement on a follow through, and price ends up absolutely dumping. So the next liquidity pool is the previous day high and previous day low. Again, just like the session liquidity, it's a very strong liquidity pool and acts as a magnet, right? All it is that you just go on a daily time frame and you see the daily candles, that you see the wicks, right, the previous day high and previous day low, and they act legit as magnets, right? So we can see that right here we have a previous day high, previous day low get put in. Then the next candle ends up taking that previous day high, forming a new previous day high and a new previous day low. And as you guys can see, after taking out the previous day high, price the next day, the next candle ends up pretty much taking the 2 previous day lows. So again, it just acts as a very strong magnetic tool, and price literally just ends up taking out those levels and then pushing onto the opposite level. So take a quick look at example right here, right? So we have this candle, right? This is a daily candle. All you got to do is just click on a daily time frame, and then you'll see those previous day high and previous day low get put in, right? So right here we have previous day high, previous day low. As you guys can see, the next candle ends up taking that previous day high and putting up the new previous day high and previous day low. And then what happens? The next day again, price again ends up manipulating higher. See how big of a wick that we left off over here, right? And we could potentially expect to take out the next previous day low. We have 2 now, right? So as price takes out the previous day high, it ends up absolutely just dumping, taking out the previous day low, okay? And it doesn't always have to be like guarantee just because a level took out, like say a previous day low, that means it has to automatically jump back up to previous day high. No, it just acts as a confluence, right? It helps you to draw to make your draw on liquidity, helps out form your daily bias and things like that. So let's take a quick look at another example, right? So this is literally, I'm going to walk you through a few days worth of price action, right? So what do we have here? We have a previous day high get put in, right? Price ends up taking out that previous day high, and then does what? Dumps to the next previous day low and the 2 days low. So we took out 2 previous day lows, right? So then what happens after, right? We put up another candle, right? Another day worth of price action gets put up. We have previous day high get taken, leaving off this big manipulation candle. What happens to the next candle? It ends up absolutely dumping through everything, right? All the 2 previous day lows that got put up. Then what happens? We start to reverse, right? We could see that we get inverse fair value gap on a daily time frame. Again, we're starting to put things together, as you guys could see, and we put up a previous day low and a previous day high over here, right? What happens? The next day gets manipulation into that previous day low. You see how much of a big wick that we left off of. We took that previous day low, and then the next following few hours, price ends up absolutely smashing through all of these previous day highs that got put in. So it literally acts as like a liquidity zone for a price to later on take that. So it doesn't necessarily mean just because today we took out previous day low, that means the next day or the same following day we have to just take out that previous day high. No, it could act as a liquidity tool for next coming up days or even weeks, even through choppiness, right? So what do we have here? We get put up again previous day high, previous day low over here, right? So what happens? We take out that previous day low, right? Next candle ends up coming up, taking out this previous day high and this previous day high, right? So then we put up new previous day high and a new previous day low, right? So as you guys can see, you have to put this with a narrative, right? So as you guys can see, we start to do like a little reversal, right? Inverse in these 2 daily inverse fair value gaps. So then we could start to see price to come back up higher, right? So like right here, we take out this previous day low, and then we could expect for price to take out the next previous day high and following through, right? So then we could see price ends up going higher. So just to show you guys how this previous day high and previous day low price action looks inside of a small time frame, right? So we have this previous day high and this previous day low, right? If you go down on a lower time frame and try to see how price looks like inside, right? So this is previous day high, previous day lows over here, right? So how does PA look inside of it, right? So we see that price ends up coming up, right, taking out that previous day high, right, with a massive wick left on top and no follow through, no displacement, no candles closing above this previous day high. So we could expect this level to be like a manipulation level, right? We see that this big wick ends up getting left, and then we could potentially see the previous day low be as our draw on liquidity and a very important liquidity pool, right? We could also put this together with the session liquidity, which was literally discussed a few minutes ago, right? What do we have here? We have Asia low over here, we have London low over here that haven't got taken out yet, right? So this is very, very strong magnetic tool. This is literally, pretend like this is a magnet, right? This is a lot of liquidity is resting, right? Not only do we have a previous day low in here, but we also have Asia low and London low. So this is even adds up to our confluences to potentially see price come down lower, take these levels out. So let's see what happens. Price ends up forming, and then boom, the next few candles will end up taking out that level, right? Although it happened the next day, right? Which, you know, you could expect that, right? We saw a big wick getting left off of at the bottom, right? No follow through below, right? We don't see any candles closing below. We don't see any displacement going lower. We see this massive wick. So that means now we have PA potentially going back up higher now, right? So this is used as a draw on liquidity and daily bias, right? last example, right? What do we have here? We have previous day low, previous day high get put in right now. How do we look inside of that range, right? So again, what do we have here? Not only do we have a previous day low over here, we also have London low that hasn't got taken out yet. So, and you guys could see like price ended up coming lower, didn't take out this level. So now we could start to potentially see maybe this low act as a very strong liquidity zone, right? So let's see what happens. As you guys could see, price ends up coming lower all the way down here, right? Taking out the previous day low, leaving off these massive wicks, right? There's no candles closing below it, no displacement following through. So this acts as a manipulation level, right? We have not only previous day low, but also London low that got taken out. So there's two liquidity zones piling up together, right? So it just adds up to our confluences. And then the next very few candles, right? We leave off this very important previous day high, and price ends up absolutely smashing right through it all, right? Now, a very good thing to do right before every session starts, pre-market, whatever, whenever you chart your things out. So it would be a very good idea for you to mark out the previous day high and previous day low to see the range that you're trading in between, right? Just to kind of see where are we, like what can we potentially take out as very important liquidity zones, right? Next up, we have low resistance liquidity, right? Also known as trendline liquidity and failure swings, right? So pretty much why is it called like trend line? Because a lot of the retail strategies tell you, okay, like once you start to see kind of price to pile up over here, right, all these lows fail, right, all these failure swings, you could just pretty much draw a trend line and have that as act as a support, right? Again, for a bearish example, right, we have this low resistance liquidity, right, all these failed highs that got put up, right? So a lot of the retail traders will be like, all right, just, draw this trend line, and once price ends up coming up to this trend line that you drew, like a random line that you drew on the chart, will act as a resistance. Like, yeah, it works for a certain period of time, but not really for a long period, because eventually what would happen is price would end up absolutely smashing through all that low resistance liquidity, because a lot of generate liquidity, a lot of stop losses resting over here. So this acts again as another magnetic tool, right? So this is literally acting as a magnet, because all of these failed swing highs and swing lows are generating liquidity and leaving off all these stop loss orders that could be later on taken out. So let's take a quick look at example, right? What do we have here? We have all of this massive low resistance liquidity that got put up, all these failed swings, right? We kind of have like a little mini like liquidity sweep of this previous low, right? But price ends up coming higher and then absolutely just going through all of that low resistance liquidity, right? Just absolutely smashing right through them all. So another example, right here we have our trend line that could be potentially working as trend line support, right? Resistance, right? All these swing the highs that were felt to go up higher, right? What happens then? Price ends up absolutely going all the way back up higher, taking out all of this low resistance liquidity, because all of these failed highs, we have all the stop orders sitting and resting above it, right? It's not that necessarily that these like market manipulators or whoever the hell controls the market, it's not that they're hunting your retail stop loss, that no, but it just acts as a very good generated liquidity for price to target, right? Because all these swing highs, they failed to make prices go up higher, so now it acts as a very strong liquidity pool. Anytime you see like a staircase for price action, right, literally people that are retail traders that trade trend lines, it's not, I'm saying that trend lines do not work, it's necessarily that I don't really trust them, because anybody can draw some lines and there's no narrative, there's no really anything behind that supports the idea of trend lines, because it's literally just drawing a line where price keeps bouncing off of. It's not going to infinitely do that. And yeah, sure, somebody could make it work, but a lot of times for long term it does not work, right? So like, what do we have here? We have this massive low resistance liquidity getting piled up, right? Look at this, it respected once, twice, 3, 4, 5, it keeps on respecting, right? But eventually what happens, price just ends up absolutely running right through all of that, right? So, and this is usually working more kind of towards the lower time frames, right? We have all the general liquidity being formed on usually on lower time frames. We do have low resistance liquidity also forming on higher time frames, but not as often as you would see on lower time frames, right? So again, it's just a very good way for people to see that as drawn liquidity, for you to kind of have your daily buys and be like, okay, if I'm bullish and I'm seeing all this bearish trend line liquidity, all this bearish low resistance liquidity getting formed up, now this all could be acting as a very good price for level to eventually take out. And as you guys could see, price ends up absolutely smashing through all those levels with a lot of displacement and follow through. So next up, we have equal highs and equal lows, right? Again, just like the low resistance liquidity, a lot of retail traders, they get taught that, all right, if you see price end up tapping on the same level exact, it has to be the same exactly, like exact high and low, point for point, right? And you guys could see that, okay, our previous high that got tapped into at the same exact price. We see a reaction off of it. That's it. That means that acts as a resistance. Same thing for this bullish scenario, right? We have these equal lows, right? When price comes lower and then makes the same exact low, right? And then price ends up going higher. People that are retail traders end up being like, okay, well, there's an equal low, and this just acts as a support, and then price ends up going higher, right? But we don't really trade. Um, we don't really trade support and resistance because it doesn't really have any narrative. It's just pretty much looking at random levels of price just bouncing off of, and you can't. There's not really any sense of like scenario of like what's happening, what's behind it, right? It's literally just like, okay, there's equal high, equal low, support and resistance. Just buy when it touches that, sell when it touches that. That's really dumb. Like it's not. I don't think it's really sustainable for long term, right? So in this case, right, you have to see price make exact equal highs and exact equal lows, right? And the colors don't matter. This could be green, right? This could look exactly like this, right? And this could look like this. Doesn't have to be really, doesn't really matter what the colors are, as long as you guys can see just exact equal highs and exact equal lows, right? And you don't really want to pay attention to that on ES because ES is very like, ES has equal highs and equals every single day, like so many of them, right? So you don't really want to pay attention to ES, rather than you want to pay attention more on NQ, right? Because NQ is a lot more volatile, and at times that it does make equal highs and equal lows, that acts as a very, very strong liquidity pool, right? Especially if it's on a higher time frame, right? You will usually see these on like a 1 minute, 2 minute, 5 minute, right? And but if you see equal highs and equal lows on like a 15 minute, 30 minute, hourly and above, that acts as like a very, very strong liquidity pool. So the way you could see them, right, is adding an indicator, right? I have this equal highs and equal lows, right? Literally just type in equal highs and equal lows, any indicator will do, right? And it will draw out these equal highs and equal lows for you, right? So we could see that these equal highs and equals are forming a lot of times everywhere. So you see how like this equal high got put up, right? It's exactly at the same exact price, right? And then look at this massive wick that ends up going all the way higher just to take out that equal high, and then for price to end up pushing lower, right? And we can see another equal low get put up. You see this yellow dotted line, and it was also better when price isn't like together right next to each other, but rather if it makes equal highs and equal lows when it's apart, right? So you see how this was away, and then this ended up happening a few hours later, and it made an equal low. That even acts as a better liquidity pool, right? So we see that this equal low gets put up, and price ends up kind of retracing back to this fair value gap, right? We could end up targeting this equal low because it's very, very strong liquidity pool, and will act as a magnet, right? So boom, we end up taking out that low. So I was just on a 5 minute, but let's say on a 1 minute, it happens a lot more often, right? What do we have here? We have another equal high that got puts up over here, very, very prominent, very obvious, right? This is equal low. We end up kind of retracing back up here, right? And then you could potentially take an entry targeting this equal low, and as price ends up absolutely smashing right through it, right? And a lot of times this could happen like right away, or it could leave off of that equal high and equal low for later price to take it out, right? So for example, in this case, right, we make this equal high and price ends up immediately taking it out, right? So it doesn't really count anymore, right? Same thing over here, right? We have this equal low get put up and then immediately takes it out, so it's not an equal low anymore. You can't really target that, right? See again, like you see how we make an equal low, right? Price immediately takes it out, and then price ends up going higher as we also leave off of this equal high, right? This yellow dotted line, price ends up taking it out, right? So again, it just acts as a very strong magnetic pool. Like this is where price is leaving off a lot of liquidity, so prices likely will go up there and take out those equal highs and equal lows, and it will also act as a way of, let's say, if you want to enter longs, so let's say like right here, right, you don't want to enter a long right away, right? You don't enter a long like boom right here, because now we have an equal low. Let's say for example, you set your stop loss below this wick, price is most likely going to come and take that level out, and then you're going to get taken out with it because there's an equal high, there's an equal low resting below your stop loss, which is not a good idea. So like let's say for example right here, we have this equal low get put up, right? And let's say you enter a long over here, right? You enter a long over here, say your stop loss below this wick, right? It's not really good because now you have your stop loss literally resting at a very important liquidity pool, right? Because we have an equal low right below your stop loss, and price is most likely gonna take it out, and as you guys can see, it takes it out fully with displacement. So now this is on a higher time frame. We're on an hourly time frame, right? We see that right here we put up an equal low, right? So what happens on a lower time frame, right? If you go lower, we have this equal low get put up down here, right? And then let's say you see price immediately go up and you enter a long, right? You enter a long over here, you put your stop below this equal low, and you think that price will go up higher, right, and stuff like that. what happens? Price literally ends up waking out this equal low that was over here, right? And then price ends up pushing up all the way high, right? So you have to wait and see. And if, let's say, you want to enter long where equal low is made up, right? Do not enter, because most of the time, majority of the time, you're going to get stopped out, right? Because equal lows and equal highs as a very, very important liquidity pool.
Lows versus ES has a lot more of these equal highs and lows. Now this.
And last, we have data high and data low, right? This is probably one of the most occurring thing that happens is whenever a big red folder or orange folder news drop, right? And then we have this massive candle that gets put up, right? And then we usually leave off a wick all the way at the top and all the way at the bottom, right? And it's like really huge, right? We see like a very big candle because of news, right? And don't worry about news yet. We'll go further into that probably in like the next or the 2 videos ahead. But it's very, very important when these red folder news, like very, very important news, like for example, like CPI, FOMC, and things like that, right? So whenever they drop, you usually see a lot of volatility coming in the market at that specific time. So let's say if a news drop at 10 a.m., right, you'll probably see a very massive wick with lots and lots of volatility and volume get put up. And usually you would leave off of this data high and the data low, right? So what happens is on lower time frames after that, or even just in general, like price will most likely trade into both of those levels at some point, right? Most likely it will trade in the same day. If not, it will take out in the next day, but usually it happens during the same exact day of the news drop, right? So let's say this was the CPI and it dropped, right? We have this data low and data high, right? And it usually happens super fast. It happens literally within seconds, right? 1 second happens, boom, we leave off of these highs and lows. And what it pretty much is price leaving off imbalances, right? Price wasn't, a lot of buyers and sellers weren't filled at those prices, and it left off lots of inefficiencies at these data highs and data lows, which is kind of what pretty much these things mean, right? So we have lots of inefficiencies down here and lots of inefficiencies up here, which is the data high and data low. And a lot of times where you'll probably see price kind of retrace to one of those levels, right? So let's say in this case, price takes out this data low, and what would happen next? Usually for most of the time, price would end up trending back up high, right? Taking out the data high, right? So also, it's not necessarily, let's say if you see like a random candle, like random big massive volume candle, that is not a data high, data low, because news didn't drop, right? So it's not like a news candle, it's just like a maybe random volatility candle. But whenever news specifically drop, that's when you pay attention to these data highs and data lows. And most of the time, I'm not gonna say 100% of the time, but most of the time, these data highs and data lows will get taken out. And it's like probably one of the most easiest way to tell where the market will be going at this specific moment of time. So if 10 a.m. kind of drops, we leave off these data highs and data lows. Most of the time, you could easily tell, okay, one of these levels will get taken out. Once that does, and then probably the next level will get taken out. So again, use this as a very important tool, data highs and data lows. So right here we have the CPI candle dropping at 8:30, right? So what do we have here? This candle ended up forming, right? Look how massive. This is like a 155 point move, right? And this is due to CPI dropping at 8:30, right? So then we could go ahead and mark out the data low and the data high, and you're most likely going to see price retrace back to either one of these levels, right? Either data low and data high at first, and then price will go in the opposite direction and take out the previous whatever data high or data low, right? So let's see what happens. We have here, boom. So the 1 minute time frame, right? We took out that data high, right? And now we will most likely expect price to come up and take out the data low, because these are very important liquidity pools, right? This is where a lot of inefficiencies are resting at, right? Because price moves super quickly, right? So now price needs to retrace back to those levels, right? So let's see what happens next. Then boom, price ends up coming all the way lower, taking out that data low, and then, you know, we start to see price going into either direction, right? So this is a very important tool, right? Anytime you see news drop, right, at 8:30 or wherever the time is, and you see the data highs and data lows get left behind, just mark them out, and trust me, it's gonna save you most of the time. It's literally super easy to bank off of these kind of moves, because majority of the time this will happen. Price will always go into those levels, take out those data highs and data lows, because that's where lots and lots of liquidity is resting at, right? Okay, so then the very next day we have another news drop, which was the PPI and core PPI, right? And again, it's a red folder news, right? We see a lot of volatility getting put up in the market, right? Again, 80-point move that just happened. We left off of a data low, we left off of a data high right now. This acts as a very strong magnetic tool, right? This is literally what price most likely will retrace to, right? So let's kind of see what happens, right? So we start to see price kind of trading between this range, right? And then boom, the next candle ends up taking out the data high, right? we kind of play around with it, make a wick, right? This could potentially be a liquidity sweep of this data high, and then you could potentially see price end up retracing back down low to the data low. So let's see. Boom. Then price ends up retracing all the way down here to the data low, and as you guys could see, both of the data high and the data low got taken out. And yeah, this is literally such an easy tool for you guys to use and just put in your arsenal just to help you go the draw on liquidity and things like that. So yeah. Now, before I wrap up the video, I just kind of want to put all these things that I just taught you guys together just to see how it would react on a daily basis, right? So how would you use them on, every single day? So let's take a quick look at it, right? So let's say you have this trading day that happens, right? And we trade up, we leave off, let's say this 5-minute equal highs, right? We leave off this 5-minute equal highs that hasn't got taken out yet. When price ends up trading lower, right? Let's say right here is 8:30 news, right? Ends up going all the way up here, leaving off of this data high that didn't get taken out yet, right? So this is also, we left off of Asia low below over here, and we left off of a London lower. So price ends up trading lower, right? And as price starts to reach closer to the market open, which is the New York open, right, we start to generate this low resistance liquidity, this trend line liquidity, right? And let's say as 9:30 closer to 10 a.m., let's say it opens up, right, and New York session starts to trade up, and then New York session ends up going lower, right? Let's say New York open and it reaches 10 a.m., right? And then we took out this London low and we took out the Asian low, but now we start to see some sort of a reaction right off of taking out these lows, right? And then we start to see price come back up, right? Now, how would we use this, right? Like, how do we put all these things together, right? So we have all of these levels that haven't got taken out yet. This could act as a very, very important liquidity pool, right? This is literally easy money. Like, literally, you see this, nothing got taken out. You should be 100% confident that this is so easy, like free bread, literally free bread. We took out Asia low, we took out London low, right? Let's say there was like a fair value gap also below over here. This is like A plus plus plus. I'm just giving you guys the best case scenario just in terms of everything, putting things together, right? We have low resistance liquidity laying down right here. We have data high and we have equal highs above it, right? So now, even using the fair value gap video that I put up, right? So let's say right here we form a fair value gap, right, that gets ran through, right? So then boom, we could confidently enter this long, right, targeting the low resistance liquidity, targeting data high, and targeting equal highs. Obviously price won't just automatically jump up and take out all of that at once, right? But your drawn liquidity is confirmed, your daily bias is confirmed. Now you could see all of these things being as a very strong liquidity pool, just acting literally as a magnet, because all of this is literally free. Nothing got taken out yet, so you should be very, very confident in this trade. And most likely what you're going to see is price kind of retrace back into this inverse fair value gap, and then you start to see boom, low resistance liquidity got taken out. Then we start to see price trade up, taken out the data high, kind of retrace a little bit, maybe chop around a little bit, then go up higher, boom, and then taking out the equal highs, right? So obviously in a matter of all of this process, you want to be taking out partials everywhere, right? So once low resistance liquidity got taken out, take out a partial over here, right? Take out some portion over here, right? Then move your stops to break even, right? Now the trade is risk free. Then once price ends up going to data high, take out more, right? And you could potentially even start to trail your stop, let's say down here to this low, right? Just to be more secured. Price retraces back down, and then final TP is the equal highs, right? And then boom, once it hits that, and then your final TP got hit, and then you're out. So this is essentially how you would be putting all these things together, using the session liquidity, then the low resistance, the data highs, equal highs, and all these things. So, the point of this video was just to kind of show you very important liquidity pools, right? Now, this probably will be a very long video because there's a lot of sauce and a lot of content that is included in this one specific video. So take your time. If you guys didn't understand anything, just rewind back, rewatch this video multiple times, because again, like I said, this is kind of the foundational like building blocks of every single strategy. Literally most of the strategies start off with one of these. Like, it literally has some sort of liquidity involved in their strategy, and that's kind of how you would form your drawn liquidity, how you would form your daily bias, to what are you going to target, what potentially you could see being like manipulated, and where can you expect to distribute, and all these things, right? So yeah, if you guys enjoyed this video, please put a thumbs up, and if you guys didn't understand anything, drop a comment down below and I will help you guys out. So yeah, that was it for this video, and I will see you guys later.